Does the BRRRR strategy work with apartment buildings? You're going to hear all about the BRRRR strategy when you're talking about single-family homes, small plexes like duplexes, triplexes, properties like that. But does it actually work with large-scale multifamily apartments? That's exactly what I'm talking about in this video, and I'm actually going to walk you through how we add value, maybe using the BRRRR strategy, maybe not, with apartment buildings. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. I'm Seth Ferguson. Let's get right into it and talk about BRRRR strategies in apartments. To start things off, I think it's really important, just in case you've never heard of the BRRRR strategy before, to actually walk through what this acronym really means, and then we'll dissect it and figure out how it actually works with apartments. So BRRRR stands for you buy, you renovate, you rent, you refinance the property, and then you repeat. So let me just run through this real quick. So first of all, you acquire the property, right? Where you can add some value to it, right? Whether it's a renovation, something of that sort. Then you're going to actually renovate the property. You're going to do the actual physical work to bring it up to the standard where you're aiming. Then you're going to rent the property. So you're going to bring in a tenant. They're going to move in, start paying you rent for the use of the property. Then you're going to refinance the property. So you're going to add more debt on the property now that you have income coming in. And then that allows you to pull out capital so then you can take that chunk of money to hopefully move to another property and repeat the process. That is the BRRRR strategy in a nutshell. And when you're talking about single family home investing, small plexes, almost everybody talks about BRRRR strategy. And me being Canadian, BRRRR, it just reminds me of the winter time. Now, when it comes to apartments, the question is, do we actually follow this strategy when it comes to apartment buildings and building our portfolio that way? There's a couple things I want to touch on as I answer this question, and I may go off on a couple tangents, just warning you. First of all, it's important to have the right frame of mind when we're assessing and looking at apartment investing rather than just buying a single house or a duplex, right? With apartments, what we're really doing, we are buying a business. So this will be our business. Oh, my box was too small. And we're buying a business that produces cash flow in the form of NOI. And this business just happens to be tied to real estate, right? First and foremost, we're buying a cash flow producing business that just happens to be tied to real estate. And the business of apartment buildings is we provide housing, a community for our tenants, right? That they are our residents. That is the service we are providing. Everything with how multifamily apartments are valued, how they're treated as a business. And I just say we are acquiring a business that just happens to be tied to real estate. And I'll put a link right up here to a video I did explaining all about the valuation method. It's called the income approach. So click on that video if you want to learn how these apartments are valued. Now, when it comes to the BRRRR strategy, do we actually employ the BRRRR strategy, how it's written here for single family homes and apartments? And the answer is kinda, right? Let me walk you through what I mean when I say kinda, right? First of all, we're going to acquire the asset, right? So we're going to buy it. 100%. You know, it's the same thing. We need a project, a property to start on. And then here we're going to renovate. But when it comes to apartments, there's actually two different components that we look at when we're adding value to the asset, right? The first one is physical. And then the other one is operations. I'll just say ops. So with physical components, we may be doing physical renos, right? So interior, exterior, adding amenities, and I'll just stop writing because you won't be able to read my writing after this point. We may be adding fencing, renovating the pool deck, adding a pool, adding other things, changing the roof line, landscaping, all the physical aspects we can do. This remains the same. Now for ops though, which isn't really included in renovate, right? Because here, if you're buying a single family home, there's no systems involved, even with a duplex, triplex, there's no business systems, there's no staff, there's no hierarchy, there's nothing of that sort. But with apartments, because we're really buying a business that just happens to be tied to real estate, we have all sorts of things that we can work on with operations. We can work on marketing. We can actually change the staff on the property. Maybe we have a low conversion ratio when it comes to leads, prospective tenants, and their closing rate. Maybe we have to have more staff in place, different staff members. We can, depending on the state or the province you're in, you can implement a RUBS program, so you can actually bill back expenses, utilities to the tenants, and that takes it off your hands and places the onus on the tenant to be more responsible with their utilities. You can add extra services such as trash pickup, covered parking. And the whole idea with physical and operational value add is to drive the NOI, right? So we're going to increase the gross rents. So we're really pushing to increase our gross revenue. And then we are looking to optimize our expenses or lower our expenses, and that's going to improve the NOI. If you're not sure what the NOI is, I'll put a link right up here to a video I did explaining all about the NOI and how you calculate it. So when it comes to the BRRRR method, yeah, we got buy, check. We've got renovate, and this is where it's kinda, right? We're doing a little bit more because it's a more sophisticated system. And we are renting the property. That remains the same, right? The whole idea, let me give myself some space here. So let's say this is market standard right here, right? We have a couple properties right here at market standard, charging, providing what the market expects and charging what the market expects. We buy a property under market standard, and our goal is to actually bring the property from here all the way back up to standard, right? There's a delta here, a gap, and this is our profit, right? This is where we're manufacturing the value up, doing our physical renovations and our operational efficiencies and finding what we can do to drive that NOI. This is exactly what we're doing. So let's say, for instance, our rent's $1,500 a month. If we can drive that up to $1,750 a month, where market is, right? We have a $250 premium that we can now charge per unit, and you multiply that over 100 units, 200 units, and then you can see how it really drives the value up that way. Plus it improves cash flow and all the other things. And then with the BRRRR strategy, we want to refinance. And with apartments, you can also add more debt to the property. Now, here's something to watch out for when you're looking at a prospective deal. If there's an operator, if you're looking to passively invest in an apartment and they are promising you a refinance at some point, ask some more questions. That could be a red flag because you never want to promise a refinance at some point because you don't know what the future will hold. It may or may not happen. Maybe the debt market, falls apart at that time and you can't get the financing you need. You should never, ever, ever promise a refinance in year 2, year 3 after you've done your renovations because you don't know if it will actually happen. And that leads us to a whole nother discussion about debt and the type of debt we have to look for and giving ourselves a safety net. So we'll leave that for another totally different video. But you can seek out more debt on the property because now you have a higher NOI, so the property is producing more profit, and that means it can sustain more debt. And there's so many benefits with going with apartments versus single family homes, and I'll put a link right up there to that video where I walk you through the difference between investing in like a duplex and an apartment building. Now, here's the thing, repeat, right? With the BRRRR method, the BRRRR strategy, a lot of people will keep that property and then start acquiring another property, and before you know it, you have, instead of one single family home, you have 10, and then you start building your portfolio that way. I want to just talk briefly about something called the velocity of capital, right? And this is something that I had to wrap my head around when I went from doing single family homes to larger commercial deals, right? Yes, you want to build a portfolio, but the answer isn't always just acquiring more of the same product, right? With apartment buildings, we have something that we can take advantage of called depreciation. And these are credits the government gives us for owning real estate, right? And depending on if you're in Canada or the US, how depreciation works, cost segregation, it's going to be a little bit different. But generally speaking, right, we know over time the value of land and real estate goes up. The government gives us credits because it's going down. We have repairs and all that stuff. And basically what we get is we get depreciation. So we get credits every single year, and we can use that to offset our profits in the real estate investment. That is the best thing ever since sliced bread, and as a real estate investor, you should get really, really excited when we talk about depreciation, cost segregation. Now we can use it to our advantage. Now, when we talk about the velocity of capital and really making sure our return on equity versus return on investment, let me just cover this real quick. I don't want to get too far into the weeds, right? A lot of beginner investors, they'll look at what's called the ROI, right? Their return on investment. And I've actually done a video on this. So I'll put the link right up here to that video where I explain ROI versus ROE, right? The return on investment. So they're looking at, hey, if I invest $100,000, hypothetically, what is my return? Instead of saying, okay, I have X amount of equity, so I invested $100,000, but now I have $200,000 of equity in the property. What is my return on the equity? A lot of people, a lot of beginners don't ask this question, and they end up actually with money not working as hard as it could be. That's the velocity of capital, right? We want to capitalize on the depreciation credits we can get. And also we want to maximize how hard our equity in the property. Because if you run through the value adds process for multifamily, right? If you do the physical renovations, the operational improvements, the property is going to be worth more. And now you've manufactured value, your equity in the property. Whether you've bought the apartment yourself, whether you're in a joint venture, whether you're syndicating the deal, whatever it is, you've manufactured that value. That equity now is trapped. Oftentimes with apartments, it makes more sense to keep that velocity of money going to actually sell the project, because once you've improved it, where can you go? You're just holding at that point, optimizing, managing the deal. You've already manufactured the value. You're already like 80% of the way there after you've gone through your value add process. Why are you going to hold on to the deal indefinitely if you can't manufacture more value, right? You're kind of stuck waiting for the market to appreciate. You're not controlling the forced appreciation at that point. So from a velocity of capital point of view, it oftentimes makes more sense to sell and acquire another property as opposed to like the single family strategy of you just start acquiring more houses along the way. Different way of looking at things, but with apartments, you want to look at ROE, velocity of capital, and then maximizing your depreciation. So if you would like to learn more about how you can actually do your first apartment deal, maybe you're just coming across apartments for the first time, you're interested in investing, I've got a free PDF blueprint download for you. Just go to spyformula.com, link right down below, and you can download it completely for free. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel. And until next time, happy investing.